If they will join us, they will join us along the way. Now, the last segment, we were discussing on how to carry out the substantive audit procedures, how to carry out the substantive audit procedures on the core accounts. Okay, we discussed on the non-current assets, we discussed on the inventory, we discussed on the receivable, we also did discuss on cash. Okay, we also did discuss on cash. Okay. Now today, let's discuss the what referred to as the audit finalization and review. Okay, audit finalization and review. Okay, the audit finalization and review. Okay, audit finalization and review. Now, when it comes to the audit finalization and review, okay, there are more or less what can I call them? More or less like final steps. Okay, that as an auditor, you're going to carry out, okay, before you do issue your final audit report, okay, before you issue your final audit report, okay, those are the closing, okay, let me call the closing steps, okay, before as an auditor, you can issue the final audit report that is going to be addressed to the shareholders, okay, that is going to be addressed to the shareholders, okay, and one of the final few things again recurrent, okay, of course, is the core things, the let's say two core things, okay, or three core things, okay. One being the subsequent event review, okay, the subsequent events review. We're going to have what we call the going concern review. We're going to have obtaining written representations from the management. Okay, we also going. You may also have a case of obtaining a schedule of uncorrected misstatements that have been more or less gathered along the way. Okay, a schedule of the uncorrected misstatement. Okay, more or less will also be the things that you will be doing in the closing stages. Okay, before you issue your final audit report. Okay. So let's begin the first one, okay, on ISA 560, okay, ISA 560 on the subsequent event review, okay, the subsequent event review, okay. What is subsequent event, okay, or what do you mean by the events of reporting period, okay. Now these are going to be, these are going to be, okay, let's say transactions, these are going to be events, these are going to be activities, okay. These are going to be subsequent sales, okay, transactions, okay, or events, okay, that are going to occur after the year end, okay, between the year end, okay, between the year end, okay, that is, for example, between that 1st of December, okay, until, if for example, the year end is the 1st of December, and you're issuing your final audit report on the 28th of February. So the events that occur between the year end, the events that occur between the year end, that is at 1st of December, okay, all the way to the 28th of February is referred to as the subsequent events, okay, the events after the reporting period, okay, the events after the reporting period, okay, that's what we mean by the subsequent event, okay. Okay. So the events, okay, I think I did ask you, okay, in the mock, okay, what we made or what we made subsequent event. Okay, I can't remember how the question was, but it was more towards the ISA 560 on the subsequent events, okay, on the subsequent events. The events are going to occur between the year, between, okay, the date of the financial statement and the date of the auditor's report, okay, is referred to as the subsequent event, okay, and the fact that become aware of the auditor after the year, after the date of the auditor's report. The main concern, actually, the main concern is between that 1st of December, okay. Let me just draw a simple timeline. Here is that 1st of December, okay, to represent the year end, okay, 2019, for example, and the issue report on 28th of February, okay, 2020. So the events that occur between okay, the events occurring, okay, between the year end, okay, or the time you issue a report. So this is the year end. Get the financial statement year end. This is the date for the auditor's report. The date for the auditor's report. So this is the main concern, as I mentioned. This is the main concern, okay, between the year end and the time you issue your final audit report, okay. Maybe you can also extend, okay, you can also extend after you give a report, but of course the main concern is mostly at this point, okay. The subsequent event can also cover, okay, even after you have issued your final auditor's report, okay. So in case you have to define, okay, what you mean by what is subsequent event, okay? These are going to be the events that occur between the financial statement year end and the date of the auditor's report, and okay, the events that occur after the time after the auditor has issued his final auditor's report. Okay, that means by the subsequent event. Okay, a very simple definition. A very simple definition. So you should be able to get it, okay, quite easily. Okay. Anyway, that's when the subsequent event. Okay. We see that generally, okay, the period when the auditor, okay, let me just go back here, okay. So between the financial year end, okay, and the date of the final report, okay, they have what called the active duty. So here, as not you do have an active duty, okay. You do have an active. You do need to go out, okay. You go to the management, inquire from them, look for example, newspaper cutting, okay. Obtain. You must be actively, okay, looking for this subsequent event, okay. You must be looking for this subsequent event, asking the management to provide you with any interim financial statement they may have prepared. You are the one who's going to be looking out actively for this, for any subsequent event, okay. However, once you've given your final report, once you've given your auditor's report, then here you have called the passive duty. Okay, beyond here, this is called the passive duty part. Okay, the passive duty. Okay, here in quote you can wait. Okay, for the management to inform you in case you become aware of, in case they become aware of a subsequent event. Okay, you have all of the passive duty part of it. You don't have an active duty. Okay? Once you've given out your final auditor's report. Okay, once you've given out your final auditor's report. Okay. Now, what is your key objective? Okay, what is your key objective as an auditor? Okay, with regard to ISA 560, what is the key objective? Okay, of course, it's to obtain sufficient. One of your key objectives, okay, is about obtaining sufficient, appropriate, or evidence about whether events occurring between the financial, between the year ends, okay, and the date of the auditor's report, okay, that requires to be adjusted, okay, or disclosure have been appropriately reflected on those financial statements. Okay. So obtain, so one of the key objectives, okay, is about obtaining, okay, is about obtaining sufficient appropriate audit evidence, okay, obtaining sufficient, okay, appropriate audit evidence, okay, about the existence, okay, appropriate audit evidence, okay, about the existence of the subsequent events, about the existence, okay, how they been reflected, okay, if the events require adjustment, if the events require disclosure, how they been reflected, okay, on those financial statements of the company that are meant to be prepared and issued to the shareholders, okay. That is one of your key objective as an auditor with regard to the subsequent event, okay. Obtain sufficient appropriate audit evidence as to whether, okay, any of those events that occurred, okay, it has been reflected, okay, it has been reflected, okay, in the on the financial statement of the company, okay. And of course, you need to make a response. You respond appropriately, okay, towards those subsequent events. Okay, you respond appropriately to the facts that become known to you between the date of the financial, between the date to the auditor, okay, after the auditor's report has been issued. Okay, if for example the client maybe. If, for example, you become aware, okay, after you have already issued your final auditor's report, okay, how do you now? If you become aware, for example, that there's the inventories of the company on that 1st of December, okay, maybe the company was wrong in the valuation method they used, okay, the NRV, okay, there was a mistake that was made, okay, and if that mistake, if it was to be corrected, okay, there will be material difference, okay, or the misstatement on those inventory, okay, is material, then of course you may want to make adjustment, okay, as a management, okay, to make adjustment to those financial statements, and you issue a new auditor's reports, okay. So in the second objective, okay, is about making responding. You make a response, responding appropriately, okay, responding appropriately, okay, to evidence that comes to become aware after you've already issued. After you've already issued your final auditor's report, okay. After you've issued your final auditor's report, okay. Those are more or less going to be what are your key objective as an auditor, okay. The key objective as an auditor you do have with regard to ISA 560, okay. That is the subsequent event review, okay. Now, the event, we can classify this event in two main categories, okay? There's subsequent event, okay? We can classify them in two main categories, okay? We have the so-called adjusting event, okay? We have the so-called adjusting event, okay, and you have the so-called the non-adjusting event, okay, the adjusting event, and you have the so-called the non-adjusting event. What's the difference between the two? Okay, in the case of the adjusting event, don't forget to say that this is where these are going to be events that occur between the year end and the time you issue your final auditor's report, or even after, okay, and they're going to give you information. They're going to give you information as an auditor of a condition that did exist, at the close of the year, and the year end. Okay, don't forget that. Okay, that this is going to be event. Okay, that are going to be occurring between the financial statement year end. Okay, and conventionally, at the time you issue your final auditor's report. Okay, and this event, they're giving you more information. They're passing on, they're giving more information. Let me use that term. Okay, they're giving you more information as an auditor of a condition that was in existence at the time of the close of the year, at the time of the financial statement year end. Okay, that's what we mean by adjusting event. Okay, that's what we mean by the adjusting event. Okay, they gave you a car between. Okay, they are occurring between the 1st December and the 28th of February, okay, and they're giving you information of a condition that was in existence, okay, at the close of the year, okay. They're giving you a condition at the close of the year, okay. Then you have called the non-adjusting event. Okay. Now, in the case of the non-adjusting event, okay, as for say, these are going to be events that occur between the year end, that 1st December, until all the way until the 28th of February. However, they do not give us information about they don't indicate to us, okay? They don't indicate to us, okay, the existence of a condition at the close of the year, okay? They don't show us the existence of a condition at the close of the year, okay? The non-adjusting event, okay? They give us information of things that occurred after the year end, not at the year end, okay? After the year end, okay? That's what we mean by the adjusting and the non-adjusting event, okay? Therefore, if the event are adjusting and they are material, okay, if they are adjusting and they are material, then of course that implies therefore you do need to inform the management, okay, to adjust the accounts of the company. You don't need to advise the management, okay, should you, or they could, or they should, okay, adjust the financial statement at the close of the year. They need to make adjustment, okay, to the financial statement, okay. If they are not material, okay, then you may want to maybe ask them, okay, to make a disclosure, okay. If they're not material, okay, then you may want to ask them to make a disclosure on the financial statement. Okay. If they are non-adjusted events, okay, but they are material, okay, if they are non-adjusted events, but they are material, okay, then of course definitely you may want to ask the management to make the appropriate disclosure on the financial statement. Okay, they make the disclosure on those financial statements. Okay, that is more or less about the adjusting event and the non-adjusting event. Okay, adjusting event and the non-adjusting event. Okay, I think that's what I think in the mock I was asking you to make that distinction about adjusting event and the non-adjusting event. Okay, the distinction between the two of them, the adjusting event and the non-adjusting events. Okay, question. Okay, because I don't think there's anything else. Is there anything else about adjusting events? The key thing you do need to get with regard to adjusting event, it's more towards what are the objectives of the auditor, okay, or the key distinction between adjusting event and the non-adjusting event. Yes, and I think that is it. I don't think there's anything else. We may want to know about adjusting and the non-adjusting event. I think that is it. Unless you have a question. Okay. If there's no question, then I guess we can go to the next bit, okay, which is on the ISA 570 on the going concern. Okay, it's 570 on the going concern. ISA 570 on the going concern. Now, when it comes to the preparation of the company financial statement, okay, conventionally, okay, the management of the company shall be making assumption that we are going to be preparing this financial statement based on using the going concern assumption, okay. Now, what is the going concern assumption, okay? The company will be in operation, but it is an assumption that you're going to assume the company shall be in operation into the foreseeable future. The company will be in operation into the foreseeable future, okay? And the management has no intention, and the management have no intention of liquidating the company, okay? The management have no intention of liquidating the company, okay? That is an assumption that we normally make, okay? The company will be in operation into the foreseeable future, and the management have no intention of liquidating the company, okay? You need to mention that part of the intention of the management, okay? The company is or will be in operation into the foreseeable future, and the management have no intention of liquidating the company. Is the otherwise, I think the question I asked you had 3 marks, okay? So far that's 2 marks, okay? The company will be in operation into the foreseeable future, 1 mark, and the management have no intention of liquidating the company, another mark, okay? There are 3 marks. If that is not the case, then of course the company is meant to prepare the accounts on the breakup basis, the liquidation basis. The other marks come in here, okay? First is that the management, okay, first is that the company will be in operation into the foreseeable future, okay, and the management have no intention of closing down the company, of liquidating the company. If the company is not, if the assumption is not applicable, okay, then definitely the company is meant to prepare the accounts on the breakup basis, okay, then the other marks comes in here, okay. That's how the marks were, okay, in that particular case, question I gave in the mock, okay. Then when it comes to the going concern, don't forget, it is a management, it is a company that is meant to assess whether it is a going concern, okay? It is not you as an auditor who is meant to do this, okay? It is a company that is a company management that are meant to make their own individual assessment, okay? We as a company, are we a going concern, okay? Are we a going concern company, okay? It is a management who are meant to make their assessment. You as an auditor is to evaluate. Okay, don't forget about this. Okay, you as knowledge is about reviewing whether the company use of going concern assumption is appropriate. Okay, so you as is not to make an assessment. You as is to make an evaluation, to review. Okay, as to whether the company use of going concern in preparing the financial statement is appropriate. Okay, that is your work. It's not about you don't make an assessment. You review, you evaluate. Okay, the company use of the going concern assumption in preparing the financial statement. Okay. Now, with regard to the going concern, maybe the key thing, okay, maybe could be what is your responsibility, okay? What is your responsibility as an auditor, okay? Of course, the key responsibility you have as an auditor is to obtain sufficient appropriate audit evidence as to whether the company is a going concern, as to whether the company use of going concern assumption is appropriate. Okay, that is one of your key main responsibility. Okay, this company has prepared accounts on the going concern basis. Therefore, you as an what do you do? You need to obtain sufficient appropriate audit evidence as to whether the management use of going concern assumption in preparing the financial statement is appropriate. That is your responsibility. Okay, that is your main responsibility as an auditor. Okay. Otherwise, you respond appropriately, okay, if the company use of going concern assumption is inappropriate, okay? They make the response, you respond appropriately, okay, as an auditor, okay? Then, so first thing, obtain sufficient appropriate evidence, okay? Second thing, you respond, okay? Conclude as whether based on the evidence, okay? Based on the evidence you have obtained, okay? Based on the evidence you have obtained, okay? Could there be what we mean by material uncertainty, okay? Could there be existence of material uncertainty, okay? And has the company made the appropriate disclosure, okay? If not, step 3, okay? Now you make the response, okay? So the first step is obtain sufficient appropriate audit evidence as to whether the company use of going consumption is appropriate. Next, could there be existence of material uncertainty on the financial statement of this company? Then C, number 3, you respond now, okay, based on number 1 and number 2, okay? So those are the 3 main responsibility you have as an auditor with regard to the going concern, Okay, let me repeat. First one is obtain sufficient, appropriate, or the evidence as to whether the management use of going concern assumption is appropriate. Then two, okay, assess whether there could be existence of material uncertainty and the company have made the appropriate disclosure with regard to those material uncertain events. Then number three is numeric response. You respond, okay? You prepare the counsel, you prepare the report in line with what you've done in number one and number two, okay? And those are your responsibility as an auditor in regard to the going concern. Because sometimes the examiner asks, okay, what is your responsibility as an auditor with regard to the going concern as required in ISA 570, going concern assumption, the going concern review, okay? We said generally, when it comes to drafting of the auditor's report, okay, when it comes to drafting the auditor's report, okay, you pay attention to whether first, let's begin with the going concern. Was the going concern assumption used appropriate? Okay, if the company use of going concern was appropriate, okay, then of course you give a unmodified opinion. Okay, you give therefore unmodified opinion. You give an unmodified opinion. Okay, if the company use of going concern assumption was appropriate, then of course you simply do give the unmodified opinion, a clean opinion. Okay, the company has gone ahead and prepared the accounts of the company, okay, on the going concern basis, okay, and it is appropriate, okay, then simply you do issue what you mean. You're simply going to be issuing, or remember, the unmodified opinion, a clean opinion, okay, sometimes referred to as the unqualified opinion, okay. Now, in case there exists, okay, now let's say if not, okay, let me say if not, if the company has prepared the accounts of the company, if the company, okay, has prepared the accounts on the going concern assumption, however, the use of the going concern assumption is inappropriate, okay, the use of the going concern assumption is inappropriate, what do you do, okay? What do you do in case the use of the going concern assumption is inappropriate? Don't forget that it may imply, therefore, okay, the company has prepared the accounts on the going concern basis. However, they are meant to use the liquidation basis. They are meant to use the breakup basis. Okay, they are meant to use the breakup basis. Okay, if that is the case, okay, where the company use of the going concern assumption is inappropriate, okay, what do? You issue a diverse opinion. Okay, you issue a diverse opinion. Okay. Simply, the accounts of this company do not present, a true and a fair view, okay? The accounts of this company do not present a true and a fair view. And actually, this is one of the disagreement of matter, the company use of going concern assumption, because I think I asked you, okay? I give example of a disagreement of matter that can exist between the auditor and the management. This is one of the example, okay? The company use of the going concern assumption, okay, is inappropriate. Okay, if that's the case, therefore, don't forget the company. You're meant to, okay, as a company, you're meant to as a company, okay, that they cannot prepare the accounts. They cannot prepare, okay, the accounts based on the going concern assumption. In case they go ahead and continue preparing them on the going concern basis, okay, then of course you're going to issue what do you mean by the adverse opinion. The accounts of this company do not present a true and a fair view. Okay, clear? Now, in case, okay, that is very clear. Okay, in case material uncertainty exists, in case you have material uncertainty exists, if the company has made in this case, the company is meant to make a disclosure. Okay, it's about the disclosure. Okay, therefore, as a auditor, ensure that the management have gone ahead and made the appropriate disclosure with regard to that material uncertain event. Okay, they have made disclosure with regard to the material uncertain events. Okay, if the disclosure is appropriate, then of course definitely you're going to issue unmodified opinion. Okay, you're going to issue unmodified opinion. Or unqualified opinion, okay, unmodified opinion, but with an emphasis of matter paragraph, okay, with an emphasis of matter paragraph. Okay, you're going to emphasize, you're going to tell the users, hey, the accounts of the company are okay. However, you need to become aware of the following 1, 2, 3. Okay, that hey, some of the things that might occur might mean that you as a company, you may not be so well when it comes to your future operations. Okay, you may be in jeopardy. Okay, towards the chance of you operating well in future. Okay, but the management have gone ahead and made this disclosure. Okay, so in case the disclosure is appropriate, there is a material uncertainty. Okay, and the disclosure is appropriate. Of course, you issue unmodified opinion, unmodified opinion. Okay, with an emphasis of matter. Okay. If the management have not made the adequate, if the disclosure, okay, is not adequate, you're not satisfied, okay, you're not satisfied as an auditor, then what do? You qualify the council company, you issue a qualified opinion, okay? Remember, a qualified opinion, okay? A qualified opinion, okay? Or in worst case scenario, okay, you issue adverse opinion, okay? You issue adverse opinion, okay? Those are the opinion that you can issue as an auditor, okay, in relation to the going concern. Okay, so don't mix them up because sometimes the examiner is going to ask you, okay, in the following scenario, okay, what opinion can you issue? In the following scenario, what opinion can you issue as an auditor? Okay, I think that is it. Any question?
Can you please explain on the meaning of material uncertainty?
Oh, what do you mean by material uncertainty? Okay. Now, generally, we say that an event might be considered to be material uncertainty, okay, if to your own judgment as an auditor, okay, if to your own judgment as an auditor, it's worthwhile, okay, for the users of the financial statement. It's worthwhile for the users of the financial statement to become aware of it, okay, and this event, okay, it might cause jeopardy to us company future operations. Okay, it might mean that the company chance of it operating future well, okay, it being able to operate effectively, okay, might be put into jeopardy. Okay, you as an auditor, you think that it's worthwhile for the users to become aware of it. Okay, so in case in your own judgment, okay, this material or this event, okay, might mean the company might not be able to operate effectively in the future, and you think that it's worthwhile for users to become aware of it, then that may be material uncertainty or material uncertain event. Okay, so it's a matter of your own judgment as an auditor. It's a matter of your own judgment as an auditor. Okay, and you think it's worthwhile for the users to become aware of it, the user of the financial statement to become aware of it. Okay, that's meant by material uncertain event. Material uncertain event. Okay, I hope it's clear coming. Okay.
Yes.
Yeah, so don't forget, it's about a matter of your own judgment as an auditor, okay, where you think that the users should become aware that this company may not be able to operate in the next 3 years, the next 4 years, okay, the next 10 months if the management do not do something, okay. So you as only think that it's worthwhile for users to become aware of it, okay. An event that might mean the company might cripple the company chance of surviving, and you think it's worthwhile for users to become aware of it, okay. By material uncertainty, or sometimes referred to as inherent uncertainty. Okay, in the old questions. Okay, I think in the old question bank questions, you may see that being asked. Define inherent uncertainty. Okay, but in the new answer is material uncertainty. Okay. Any other question? Okay, so that's on the going concern. What else on the going concern? Maybe the indicators. Okay, when it comes to evaluation of the going concern, okay, when it comes to evaluation of the going concern, okay, what do you look at for? Okay, what do you look at for? Okay, as an auditor, when it comes to the evaluation of the going concern, okay, there are a number of things that you look out for, okay, or you're going to classify as indicator of the company not being a going concern, okay, or we'll call chance of it not being a going concern, okay. And the indicators, we classify those indicators into 3 classes, okay. We have financial indicators, we have the operational indicators, we have others. Okay, we have called others. Okay, those are 3 class of indicators that when it comes to the evaluation, of the going concern. When it comes to the evaluation of going concern, you do look at for financial, operational, and others. Financial, I was quite surprised that some of you seem to have no idea what was happening here. Financial is about the finance, okay? It's about, let me see, it's about figures, okay? It's about financial figures, okay? It's about the financial figures, the debt of the company, the profit of the company gearing, okay? The company current ratios, okay? The company not able to obtain more money from the markets, okay? Now this is about the company, is about, let me see, is about they're quantifiable. Let me use that term. Okay, these are things that are quantifiable. Okay, there are some figures you can put on it on them. Okay, it's about financial. It's about the money. Okay, in whatever context it's going to be. Okay, in whatever context it's going to be. Okay, either you're not able to make more, you're not able to make profit. Either you have more liabilities than assets as a company. Either you have case where the current assets of the company are less than current liabilities. Either you're not able to obtain more debt finance. Okay, you have a loan is maturing and seems that you can't be able to negotiate better terms. Okay, the supplier is from giving you credit to cash basis. Okay, these are about, it's about the finance. Okay, it's about the money. Okay, that's the term. Okay, and it should be easier to answer. Operational is about what might prevent you from being able to operate as a company. Okay, not about the money side now. Okay, let's leave alone about the side of the money. What might prevent you, okay, from being able to make profit, for example? Okay, what might prevent you from being able to make profit, to operate effectively? Okay, if for example there's going to be a new competitor was coming, okay, therefore the founder of the company without replacement, instead of going to be a good concern issue. Okay, case of you cease being able to get supplies, okay? So the supplier maybe is not able to deliver your supplies on time, okay? What might hinder you from being able to operate, okay? Leaving alone the side of the finance, leaving alone the side of money, okay? Remember the operational indicators, okay? I was surprised that most of you got confused in that in the mock paper, okay? I was quite surprised, by the way, okay? Don't forget, operational is things that might mean that you're not able to operate. Okay, in this case, under the operation, we don't forget about the money side. Okay, forget about the money. Okay, so money is about the financial side. Okay, things that might mean that you may not be able to operate effectively as a company. Okay, in case the manager want to liquidate, it's not because they have done for the money, but it's the intention they have. Okay. In case there's a new competitor who is too strong compared to you, okay, what's happening in the market, okay, loss of key man without replacement. Okay, so all these are indicators, are operational indicators. Okay, supplies, as I've just mentioned. Okay, supplier sees delivering is the can't or you can't be able to obtain the important supplies on time. Okay, so those are financial indicators. Okay, those are operational indicators. For the others, okay, I think I mentioned the only four of them. Okay, changing law, for example. Okay, a changing law that may mean that you're out of business. Okay, I give the case of the change of law in Kenya about the plastics. Okay, in case there's a law that comes in that outlaws your business, that's the end of your business. Okay, where the Kenya law says that going forward, okay, there will be no sale of plastic paper bags. That means, therefore, in case you do manufacture plastic paper bags, that's the end of your business. Okay, unless you diversify, okay, it might mean the end of the business. Okay, in case you have got an insured catastrophe. Okay, okay, catastrophe, okay, that are underinsured. Okay, what if maybe there's going fire that breaks out in a company? Okay, can you survive that breakout of the fire? Okay, whereas you're not insured against fire. Okay, okay, those are the indicators. Okay, and when it comes to evaluation of the company going concern, okay, then of course you do need to assess from all those three angles: financial indicators, operational indicators, as well as other indicators. Okay, all those are things that you do need to check out for. Okay? As I mentioned, in case you are the auditor, don't forget you do, okay, need to make a review and evaluation. You don't make the assessment. The assessment is done by the manager for at least 12-month period. Okay, for at least 12-month period. Okay, you is to make an evaluation. Okay, question? Okay, and by the way, these are some of these are free marks, by the way, in case you have gone through, in case you have done your work well, this is some of the free marks. Okay, you should go to obtain these marks. There's some of what I mean free marks. Once you see the indicators of going concern, okay, there's some of the few questions you should start with. Okay, because if you want more information, I always say that I normally give you this ISA so that in case you want more information, then you can simply make a reference to the ISA. Okay, you can submit it easily. Okay. Okay, if there's no question, then I guess we can do to the next bit on ISA 580. Okay. ISA 580. This is on written representations. At the end of the day, okay, don't forget that you do need to get some confirmation. Let me call them confirmation, okay, from the management. Okay, there are things that generally, okay, it is a management who are going to provide you with some certain set of information. For example, the intention to liquidate, when you just mentioned right now, in relation to ISA 570. Okay, where do you take this information from? Only from the management. Okay, so you have to ask them. Okay, does the company has any intention of liquidating? Then they make a response to your inquiry. They make a response to your inquiry. Okay, now the response, okay, to inquiry so referred to as the written representations. Okay, so this is going to come from the management to you as an auditor. Okay, and don't forget, this is as an audit in itself. The written representations themselves, they are source of your audit evidence. Okay, the source of the audit evidence of the company, or of you as an auditor. Okay, the source of your audit evidence. Okay, to you as an auditor. Okay, when performing your work. However, we mentioned, okay, if we go back to ISA 500 on audit evidence, okay, their quality is a bit lower. Their quality is a bit lower. So therefore, we use them as, okay, as collaborative audit evidence. Okay, they're meant to collaborate, okay, with already existing audit evidence. Okay, they're meant to support, okay, an already existing audit evidence which you have already obtained. Okay, so they should be only be used to support an already existing evidence which you have already been able to gather as an auditor. Why? Because essentially they have lower quality. Okay, essentially, okay, they have lower quality. Okay, what else? And maybe the formal definition of what we mean by written representations. Okay, this is a written statement, okay, by a management provided to the auditor to confirm certain matters or to support other audit evidence. To confirm certain matters or to support other audit evidence. Okay, you want to confirm certain matter. You want to confirm, for example, whether the company has any intention of liquidating. So what do? Ask the management. Then they respond to you. Okay, you want to assess that whether there's a company own this motor vehicle. Okay, they see the logbook is with a bank. Okay, so ask the manager. Okay, and the bank has not yet made the response. So ask the manager. Okay, hey, I'm here to obtain the evidence from the bank, the logbook. Okay, a copy of the logbook from the bank. Okay, and you say you own this asset. Okay, I want you to affirm that you do actually own this particular motor vehicle. Okay, so they make a response. Okay, to support on maybe already evidence you want to gather or you have already been able to obtain in the past. Okay. That's doing by the written representations. Okay, they are from management to you as an auditor. Okay, and conventionally, okay, you are the one who is going to instigate the process. Okay, you're going to be having a previous inquiry, and now the management is reporting is responding, okay, to your previous inquiries. Okay, and that's on written representations. Okay, so what would you want to obtain? Okay, they're free. Whatever you may want to obtain from them. Okay, so the content, okay, the content of this letter, okay, the content, okay, is going to be based on your previous inquiry. What are you inquiring from the management? Okay, therefore the content is going to be dependent on your previous inquiry. Okay, it will be dependent on your previous inquiry. What were you asking? Okay, what were you asking? You as an auditor, what would you want the manager to confirm to you? Okay, so it will again be dependent on what was your inquiry? What do you want to start from the management? Okay. Okay. Anything else? Okay, if there's anything else, unless you have, okay, maybe just the content. One of them could be the company, the management intention to liquidate. Okay, so you want to ask them, okay, the management intentions towards, okay, liquidation about fraud and error. If you remember, as per ISA, fraud and errors, as per the requirement of ISA 240, okay, you may want to ask the manager whether they have discovered any fraud, okay, during the audit, okay, during the year. Is there any fraud that has occurred, okay? What sort of punishment were imposed on the person who was caught on fraud, okay? You may want to ask them therefore, okay? What else you may want to ask, okay? About the accounting policies the company has used, okay? The accounting policies they have used, okay, policies, or even maybe in case there's a new standard, okay, that has come up, there's a new account standard that has the account standard that has come up, okay, how do they interpret it? How was the interpretation of the new standards, okay? So the content, as I mentioned, is going to be as diverse as your question were, okay, when it comes to assessment of anything. If, for example, there is also the case of contingent liabilities, okay, if there's any contingent liability, okay, that you may want to become aware of as an auditor, okay, so all this can come from the management, okay, they are the one who are going to make therefore this confirmation, okay, to obtain this confirmation. What else? Okay, I'm not sure anything else, okay. Maybe who was responsible, okay, this can be an acknowledgement, okay. Let me just put it, management acknowledgement of their responsibility, okay, of their responsibility, okay, towards preparing the financial statement, okay, towards the preparation of financial statement, towards the internal control system, okay. So you can ask them to make a rest, okay, the inquiry, okay. Once you make the inquiry, now they're going to be therefore be reporting to you, okay. And they're quite many. As I mentioned, the content is going to be as diverse as the questions that your question one, okay. Any question? Okay. If there's no question, then we can discuss on the auditor's report. On the auditor's report, this is a 5, is a 700, 701, 705. Okay, those are the ISAs more or less you can use when it comes to the auditor's report. For the main concern, definitely, as you mentioned, is the what are the contents, okay, when it comes to is the opinion paragraph actually, okay, of importance is the opinion paragraph, okay. Okay, so let me call this is auditor's opinion, okay, auditor's opinion. Okay, we have the first is called the unmodified, okay, the unmodified auditor's opinion, okay, the clean audit opinion, okay, so sometimes referred as the unqualified as per the old ISA, okay. And you have here the modified. Okay, in the case of the unmodified, then you have here, okay, if there is, okay, in the case of the modified, let me just call this is going the unqualified, okay, the clean audit opinion, okay. But you also have a scenario where it is unmodified, but with an emphasis of matter, okay, unmodified, but with an emphasis of matter, okay. But don't forget, as I mentioned, having an emphasis of matter, an emphasis of matter does not imply, okay, that the accounts have been qualified, okay. Is the main purpose of having the emphasis of matter, okay, paragraph, okay, is to, as you suggested, to emphasize, to draw attention of the users to some certain matter. And one of them, for example, is on the material uncertainty, okay, that do exist, okay. In the case of the modified opinion, okay, they can be modified because of two things, okay. We mentioned one of them is limitation of scope, limitation of scope. The other thing that might lead to the modification, okay, is on the disagreement of matter, okay, disagreement of matter. As I mentioned, what is scope limitation? Okay, scope limitation is a case where, as an auditor, you may not be able, or you are unable. Okay, you are unable to apply audit procedure. by whatever cause, okay, but you are unable to apply audit procedure, either because the management is preventing you from doing this, okay, or external factors are preventing you from being able to apply procedures, whatever it is, okay, but you are unable, okay, to apply audit procedure. Whatever causes you, okay, to be unable to apply the audit procedure is referred to as a scope limitation, okay. Now, in case is scope limitation, okay, if there is scope limitation, okay, and the chance of if or since you are unable, okay, to apply the procedure, since you are unable to apply the procedure, if there is misstatement that exists, okay, if there is misstatement that do exist, okay, those misstatements are they material? Let me repeat. Because of scope limitation, what the chance there could be misstatement? If there is a chance there could be misstatement, the next thing, are those misstatement material or otherwise? If they are material, okay, if they are material but not pervasive, if they are material but not pervasive, okay, then you issue what we call qualified opinion with an accept form, okay, qualified opinion with an accept form, okay, similar qualified opinion, okay. If material but not pervasive. Now, in case, what is pervasiveness? Okay, pervasiveness, I think pervasiveness, okay, imply that the matter is not going to be localized. By localized means that it is not in one area, okay, it is going to have multiple impact in other areas, okay. The misstatement is not going to be localized in one area, okay. It is going to be affecting other areas, okay. It is going to be affecting other accounts, for example, okay. It is not going to be only on, let's say, sales and credits, okay. It will be having other multiple impact elsewhere, okay. If that is the case, therefore, that is going to be in quote spread, okay, to other areas, then we see that matter is pervasive, okay. That matter is pervasive, okay. That matter is pervasive, and actually, you can also say a matter is going to be pervasive if its impact, okay, is going to be first as material. However, it represents a huge chunk. It represents a huge chunk of the entire financial statement, okay. But conventionally, we do say something is going to be pervasive. Something is going to be pervasive, okay, if it's going to be affecting, okay, not more than, it's going to be affecting more than one audit area, okay. It's going to be spread over to other areas. But also, matter can be deemed to be pervasive, okay, if they do represent a huge chunk of, okay, they're material first of all, okay, but they also, over and above that, they represent a huge area. If, for example, it's about assets, okay, they represent a huge amount of the assets of the company. If they are towards P&L account, okay, they do represent a huge, if they're expense side, okay, they're material, but over and above being material, they also do represent a huge proportion of the expense of the company, okay, they by pervasiveness, okay. Now, in case the matter is material but also pervasive, okay, and a pervasive, okay, material and pervasive, then we should call the disclaimer of opinion. The disclaimer of opinion. I cannot be able to issue an audit opinion. Simple as that. Okay. I've gone through the accounts. However, I was not able to apply my procedure. I was not able to audit the accounts of this company. Simple. Therefore, I may not be able. Okay. I may not be qualified as an auditor to be able to give an opinion. Okay. You are disclaiming. You are withholding your opinion. Okay. If we have for disagreement of matter, okay, now here we are in quote, you are disagreeing with the management, for example, okay, on how to apply an accounting policy, on the company going concern, okay, on how to interpret a new accounting standards, okay. Now, in case it's a disagreement of matter that is existing between you and the management, okay, I think I asked you to give examples of scenarios where there could be disagreement of matter. Okay, these are the scenarios, okay. How to apply a new standard, okay, the company going concern, there could be an issue regarding this agreement, the account policy to the company, this particular asset, should it be used for 5 years or 10 years, okay? So that's all is one part and parcel of disagreement of matter, okay? For example, if you just mentioned case of there's a significant event, okay? If the manager, for example, okay, do not disclose to you, okay, matters regarding to the company subsequent events, okay? Now all these are disagreement of matter that might exist, okay? Now in case if there's a disagreement of matter and the potential misstatement that can occur because of that disagreement, okay, the outcome, okay, of that disagreement, okay, might be material, okay, but not pervasive, material but not pervasive, okay, material but not pervasive, then you issue qualified audit opinion, okay, a qualified audit opinion, okay, well, in this code they call for the except for, okay, what do you mean by the except for? If the potential misstatement that can occur because of that disagreement is material and pervasive, okay, material and pervasive, then of course here we issue the adverse opinion, okay, we issue the adverse opinion, okay, material and pervasive, not just pervasive, it's material and pervasive, then we issue adverse opinion. In the case of adverse opinion, simply the users, the accounts of the company do not present a true and a fair view, okay. Most of the time, students confuse disclaimer, okay, disclaimer and adverse opinion. Okay, they're different. Adverse opinion, you tell the users, in the disclaimer, you tell the users, I cannot be able to give an opinion. In the adverse opinion, I'm giving an opinion, and my opinion is that your accounts or the accounts of your company do not present a true and a fair view. Okay, so don't confuse between these two. Okay. Question? Maybe the last thing to discuss could be, okay, what are the contents of the auditor's report? The content of the auditor's report, okay? What are the contents of the report? There are many, okay? Of course, the first thing is the opinion paragraph. Also, the examiner has asked you to mention 10 contents, okay? Because the first is going to be the first call is the opinion paragraph, okay? We have basis for the opinion, basis for opinion paragraph, the auditor's responsibility paragraph. Okay, of course, the next is the management responsibility. Okay, key audit matters. Okay, key audit matters. I think you have gone through a question that I was asking you to get 10 contexts. Okay, key audit matters. Okay, what else? Other reporting requirement. Other reporting requirements. Okay, of course, the date. Of course, the signature of the person, the engaged partner in charge of it. Okay, what else? There are the addressee. Of course, the title, by the way, addressee, title, more or less is going to be one the same. Okay, the title and the addressee, not always, but they can be two distinct things. Okay, signature, the date, the engagement partner. Okay, or the partner. It could be actually the engagement partner who is in charge of the engagement partner. So this addressee, the address of the person. This is PwC, where Nairobi, Kenya. Address of the engagement partner. Addressee, these are different. This is different. Address and the addressee, okay, they're different. Okay. Yeah, so the summary exam is just going to ask you, okay, to mention 10 of them. Okay, this has been asked in the past. Okay, so this is not something new. Okay, it has been asked in the past. Okay. Yeah. Anything else? Maybe unless now you want to ask a question.
Excuse me.
Yes, Kami.
Can we go through a question on the question bank?
Yes, sure. Okay.
May 2017, question 1B.
May 2017, question 1. May 2017.
Yeah.
May 2017, question 1B. 1B. Okay. May 2017, question 1B. Okay. So we can take a minute for the others to go through that question. May 2017, question 1B. Okay, if we suppose that you've gone through it, your firm has been appointed as the auditor of Fanaka Limited for year that falls December 2016. Explain why each of the following matters which you have not noted during the audit should or should not be included in the letter to the management and those charge governance. Okay, what do you mean by the management representation letter? Okay, so this is the letter you're going to be drafting yourself as a auditor, addressed to the management. Okay, the company upgraded the accounting system, which upon testing you noted that the system did not carry out over all the balances accurately. The different credit and debit balances considered separately were material to the financial statement, but when offset against each other, they were immaterial. Okay. Now, should you include this matter in the letter to the management? Of course, you should. Don't forget, of course, you should. Okay, and this is again one of the key things. When it comes to upgrade of the account system, if, for example, the company is migrating their data, okay, from assume they were using QuickBooks and now they want to migrate them to, let's say, the Oracle, okay, and along the way there seem to be some data, okay, that might have been lost, okay, or they seem to have some data integrity, okay, that may have been lost along the way, okay. And now when it comes to drafting this letter to the user, when it comes to when it comes to writing this letter to the management, okay, should you include it? Okay, you should include it. Okay, you should include anything that concerns data integrity. Anything that concerns data integrity. Okay, and it's really this example given here. Okay, should be you need to ask the management. Okay, how are they going to revise to ensure that the data is going to be they'll be integral. Okay, the data that they have is of integrity. Okay, it is integral in itself. Okay. It should be included in that particular letter you give me drafting, okay, addressed to the users, addressed to the management of the company, okay, with regard to their preparation, okay. As I just mentioned, one of the key things that the management might be responding, okay, is on the financial statement preparation, okay. So anything that concerns how the accounts of the company are being prepared, okay, be it material or immaterial, okay, you do need to ask the management to confirm it. So it ought to be, you need to include it in the letter you're going to be drafting, okay, addressed to the management of the company. So it should be included, okay. That's for number one, okay. Number two, the new account system had a functionality that allows online approval of transactions but by the various signatories, but it has not been activated. Okay, the signatory continued to approve transaction manually, and all transaction samples were duly approved. Does it require communication? I don't think it requires communication. Don't forget, it does not matter. Okay, if this system has maybe an online approval, it's good. Okay, in case there's an online approval. But is it going to be done manually? Yes, it's being done manually. Is there an issue regarding its manual approvals? There's no issue regarding the manual approvals. So there seem to be no issues in that particular case, therefore. Okay, but it is not a must that the approvals must be done online. In most cases, okay, most of the approvals will be done manually. Okay, anything wrong with having manual approvals? Nothing wrong with having manual approvals. Okay. So there's no need here to include it in the analysis. Okay, in the letter, you're going to be drafting addressed to the management of the company. Okay, because there's no issue here, more or less. Okay, there's no standard. There's no law that says that approvals must be done online. There's no such thing. Okay. 3, the company supplying United Fanaka was owned by the wife of the procurement manager. Okay, the wife procurement manager. However, you've confirmed that appropriate procurement procedures were followed. Anything that concerns or referred to as, I don't know whether you've done IS 24, okay? The account is number 24, IS 24, okay? On what for related party transactions, okay? Don't forget this, it does not matter whether it's material, it is material, it's upon the management, it's upon those study governance to make this decision, okay? It does not matter whether it was done in well or otherwise. Okay, there's matter that need to be confirmed by those study governors. They need to be aware of it. Okay, that we have some transactions that we do have between the procurement manager and the wife here. Okay, so upon that to make that decision, but it needs to be disclosed. Is mean to you do need to inform the management regarding the transactions. Okay, that are occurring between the procurement officer, the manager, and the wife. This is need to be it is a must actually. Okay, it is a must. And even this, by the way, okay, when it comes to the preparing of financial statement, okay, among the disclosure the management need to put in the notes of financial statement, okay, maybe not necessarily, but it's worthwhile that they may want to include them, okay, all the transactions, okay, that are occurring that to the parties that are related, okay, the CEO and the auditor is their family members. So all the transactions that are occurring between the senior personnel within the company, okay, and their maybe some other family relationship or even friends, okay, Friends not a must, but in case they are family relationship, they need to be disclosed. Okay, they need to be disclosed. Okay, therefore, you as an auditor, you do need to inform the management. They need to come aware of such matter. The requirement of the international family standard number 24. Yes, they need to do that. Okay? They need to be included. Therefore. Number 4, the bank reconciliation were required to be signed by the preparer and approved by the financial manager. You noted that 6 out of 12 bank reconciliation statements were not signed by the financial accountant, but had been approved by the finance manager. They were not signed by the financial accountant, but the approved finance manager. However, you confirm that the reconciliation were accurate. Now, this is an issue regarding. No, Kami, ask. Yes, Kami. Before I go ahead.
I was wanted to ask. I thought the letter that the auditor writes is to ask for confirmation of a few details, rather than to tell them about details. Like this point of the wife of procurement manager. Is it the work of the auditor to tell them, or the work of the management to tell the auditor?
Actually, no, don't forget the communication. Don't forget, if you are the one who has become aware of it, okay, assume that maybe, I don't know, assume that it was never tapped into, assume that even if it was, you may want to, there are things that you may want to re-emphasize, okay? No, it's not about always an inquiry, okay? There are things that as an auditor, in the letter, there are things that you may want to re-emphasize, okay, to those child governance, okay? And one of the things that you may want to re-emphasize to child governance, okay? Don't forget, this letter does not always mean an inquiry, okay? It does not always mean an inquiry. This is a letter you're drafting addressed to the management, okay? Now, they're going to make a response, okay? And the response is referred to as written representations, okay? So you may want to make a re-emphasize that, hey, you did discover, okay? Don't forget, the company, when it comes to preparing the accounts, they may be in adherence the requirement of the IFRS, okay, the International Accounting Standards, okay, the requirement of IS 24 in case we have material transactions, even actually it's the material, okay, material transactions that occur between parties that are related, it need to be disclosed. So you're trying to inform the users, the management, the requirement of this ISA requires of A, B, C, and D. The transaction should be disclosed. Okay, you're simply like sort of in quote reminding them what the ISA requires of them to do. Okay. I hope I don't know how to answer the question coming.
Yeah, you have.
Okay.
So you said you said point number 3 should be communicated or not?
It should be, yes, it should be, yes.
Okay.
Yeah, because that's what the ISA requires of the company to do. Okay, so if you discover of it as an auditor, you're simply reminding the users, reminding the management that this is what the ISA requires of us. It should be disclosed. Okay, so you ought to remind them in quote. Okay, that is number 3. Number 4, the bank reconciliation. Okay, 6 out of 12 reconciliation were not signed. Okay, now this is an issue regarding internal controls. Okay. The internal controls of the company are not working. What do you do in case the internal controls are not working? You may, should we tell the users, should you tell the management that the internal controls are not working? You should tell them. You prepare what we call a letter of weakness. I think we discussed this, okay? You may want to prepare a letter of weakness, okay? Should you make a recommendation as what they can do? You can if you want, okay? But it's good that you do improve the client system so you can make a recommendation, okay? On how they can improve their system. So yes, it should matter to include, okay? When it comes to the test of control, the result of test of control, you must, actually this is a letter you must prepare, okay? Actually it's not an option, okay? About the test of control, you must prepare the letter of weakness, okay? Help us to remember the letter of weakness, okay? You must prepare the letter of weakness addressed to the management. I did test your controls. These are the weaknesses I found. These are the potential risks, okay? And this is my recommendation. It's a must for you to do that for sure, okay? Then 5, the company was involved in structuring exercise that resulted in the discharge of 25% of the staff. You got to learn that the affected staff had filed a suit in the court to challenge their dismissal, but the matter had not been heard. Okay, however, the manager was keen to have the suit heard for them to present the issue in order for them to present the issue for reporting in the next financial year. when it be possible to establish if there was a reputable contingent liability. Okay. Now this is more towards the IS 37 provision contingent asset contingent liability. Okay. Now if we have a potential contingent liability, don't forget this is 25% of the staff member. Okay, seem to be quite high. Okay, so I would want to guess that this is going to be if the company is sued by this staff member, and assume that these staff members were doing the case. Okay, were doing the case. Will it have a material impact on the company? Of course, it will have a material impact on the company, because assume that the company is meant to pay, I don't know, for maybe pay a huge amount of money. Okay, out of the damages the employees might be awarded. Okay, should this concern the company, the users? Of course, it should be a matter of concern to the users. Okay, therefore, should it be included? Should it be included in the financial statement? Should it be disclosed in the financial statement? Okay, I guess it should be included. Okay, since it seems it's not more of provision. It seems not to be more of provision, because the case is still okay. Can we see the term here? They have filed a suit in the court to challenge their dismissal, okay, but they seem to be not, the progress is still not there, okay, still not that's advanced. So we can say that there's no need for us to have a provision. However, we don't need to have, it's more like a contingent liability, okay, it need to be disclosed, okay, it need to be disclosed, okay, this matter need to be disclosed on the company financial statement, okay. Therefore, you as what do? You remind the manager that, hey, this matter need to be disclosed on the financial statement of the company. Okay, so it should be included within the letter you're going to be addressing to those charge governors. Okay, it is a matter that requires a disclosure on the notes, the financial statement of the company. Okay, it might be a contingent liability. Okay, it might be a contingent liability, which will imply therefore a disclosure need to be made on the company financial statement. What do you therefore? You write a letter addressed to the users of the financial letter addressed to the members, to the managers, to the management of the company, that they ought to have this as a disclosure on the accounts. Okay. I hope that's clear. No, each of the marks has each of the scenario here has 2 marks. So you can't just stop issued. Okay, you cannot just stop by saying issued or should not. Okay, explain why it should be and explain why it should not be. Okay. Clear.
How frequently do they ask questions like this?
It's quite infrequent. Let me use that term. Okay, that rarely does. Okay, it once in a while, but rarely do you see such cases. Rarely do you see such cases. Sometimes maybe yes. Okay, but rarely do you see such cases. Okay, but sometimes the examiner. Okay, you may never know. Okay, so you can just prepare yourself mentally. Okay, but rarely does it happen that often.
Can we do a question on opinion?
Opinion. Okay. Do you have one?
There's 2. There's one in November 2017, question 4C, and May 2017, question 5A.
Okay.
We can do either.
Okay, let's do the May 2017 question 5A then. Okay, we can do May 2017 question 5A. Okay, so you can go through it. May 2017 question 5A. State the opinion you would give in each of the following situation. Okay, the opinion can give in each of the following situation. The books of the client were taken away by the regulator for investigation and were not available for audit. Okay, now what this is a scope limitation. Okay, the books of the company have been taken away by the regulator and you can't audit because the book are not available. Okay, now what do? If you cannot audit, that implies therefore, can you give an opinion? You can't give an opinion because the book are not available. Therefore, what opinion do you issue? It's simply a disclaimer of opinion. Is that clear? Because don't forget here, the books, how can you audit? You can't audit, okay, because the books have been taken away. Therefore, as an auditor, I cannot issue an opinion. Therefore, a disclaimer of opinion. Okay. Roman 2, provision for doubtful debt were not adequate. Provision for doubtful debt were not adequate. The data in the financial statement were misstated, but financial statement gave a true and a fair view. Okay. So all the other things seem to have given, these seem to have been okay, except, okay, this is a term here. The provision for doubtful debt were not adequate. The data in the financial statement were misstated, but financial, that the others, they gave a true and fair view. So simply, others give the other areas are okay, except on the debtors. Therefore, do you give? You do. What do you do? What opinion do you give? A call for opinion with an except for. Okay, is this clear? So in number 2, simply a call for opinion with an except for. Okay, the accounts of the company present a true and fair view, except for the bad and doubtful debt, except for the debtors of the company. Clear? Okay. Number 3, there were no provision for depreciation, and the debtors were unwilling to provide for any amount during the financial year. Now this is a segment of matter. Okay, let's continue. The amount if provided would reduce the profit by 30%. Oh, this is material now. Okay, there was no provision for depreciation, and the directors were unwilling to provide for any amount during the financial year. The amount if provided for would reduce the reported profit by 30%. So first, the profit has been affected. What else has been affected here? Come here.
Yeah.
What else has been affected? First is the profit of the company. What else?
Retained earnings.
Retained earnings. Retained earnings. Yeah. What else?
I'm not sure.
The company, but the book value of the company assets. If you don't make a provision for the depreciation, it means the closing balance of the company assets is also misstated. As you can see, the misstatement is going to be affecting multiple areas. Okay, what do you mean by pervasiveness? That's clear. Okay, it's not going to be affected on one area. The profit is being affected. The company equity is going to be affected. The company value for the asset is being affected. So it's going to be affecting many other areas. Is it material? It is material. Therefore, what do we give here? It's material and pervasive. What do we give here? Quinta.
Adverse.
Adverse opinion. Don't forget, in this case, therefore, you're going to give adverse opinion. Okay, adverse opinion. Okay. Number 4, there was a legal suit filed by a customer who was unsatisfied the goods supplied, but no provisions were made in the books. The assessment of the case by the company lawyer in case the customer has a very slim chance of success. Okay. So in case the chance is very slim, okay, what do we mean by a remote? It is remote, okay, as per the requirement of IS that 7, what should we do? Do nothing, okay. What should happen therefore? Nothing. So simply you give the modified, okay, opinion, then qualified audit opinion, okay. Because first the chance is very slim, okay, therefore it is remote, okay. Therefore, should we disclose? I don't think there's need for disclosure, okay. Therefore, we do nothing, okay. Therefore, the company, the opinion to be given should be the unqualified audit opinion, okay. Clear?
Yes.
Okay. Yeah, more or less okay. Then that is it. Any question? Any other question you may be having? Okay, now in case there's no question, let me share some slides here. See if I'm able to get them before we close off.